So I'm going to be speaking about emerging payment trends this morning. How to get paid today, talking about the consumer side and how that fits with direct marketing in particular. So the payments landscape is constantly evolving, as we know. Consumers have more choice now than ever before in terms of the ways that they can shop. In marketing, we call those channels in terms of the different ways that people can decide to shop. Some examples of that would be by telephone, by letter, responding to a mail shot, for example, TV, internet, email, and a host of other things. So lots of different ways that consumers can interact to make a purchase, and different devices too that come with that. The clever bit is providing a smart way to deliver the services and collect payment across those different channels in a seamless way. Offering a broad range of payment options and not restricting them to one particular type, which channels your customer purchases down one particular path. So the big question is, how do customers prefer to pay? With emerging payment technologies, sometimes there's a situation where technology can be leading the way. A good example of that is prepaid debit cards, for example, which have been around for 10 years or more, and a host of companies started offering prepaid debit cards when the real question was, is there actually a need for it? Rather than, here's demand, let's meet the demand by creating a payment type that's going to work for the customer. But knowing what your customers want, how they prefer to pay is obviously very important. By understanding what your customers, how they prefer to pay, you're going to increase your potential number of customers, the available customers, and the comfort level amongst your customers to actually use a particular payment type. But payment preferences do vary by country to country, region to region, and also by age group of your customer base. And if you mix that with the host of different delivery channels to sell products and services, then you can see that there are a number of ways to actually make this work. By restricting maybe to one or two payment types, you might be restricting your sales potential, where, for example, if you add one or two extra payment types to a particular target market, which could cost you a few pence more, you could increase your sales maybe up to 12% in that particular market. For example, maybe the over 50s, I should say over 60s now, who still have a tendency to use check and respond to catalogue types of service delivery. If you cut off checks and the distribution of a catalogue and steer them online, you could take a big chunk of your sales revenue out by doing so. So one size doesn't fit all. I think that's a fair point. I'm based at PacNet, the payment processing company, and a lot of new businesses, whether they're online or offline, approach me and say, Brian, can you help me with a credit card solution? And I say, well, why just credit card? Have you considered other payment types which could work well and complement credit cards? And in some cases offer a better solution in case where someone's selling a higher value item, which could be liable to chargebacks, for example, and dent your profit margin massively. So it is, whilst it's tempting to rely on credit card because it's easy or relatively easy to implement and covers multiple countries, there can be different payment types available and local payment types in certain countries which can be more popular in some cases. One way to achieve that would be to talk to an experienced payment partner which offers a host of different payment types. Whereas if you see maybe one payment service provider, or you could go to an acquiring bank direct, like maybe Barclaycard, of course they're only going to talk about what they can do, maybe one particular payment type, And really, you need to do your research and think wider, and indeed research and ask how your customers prefer to pay, and cover yourself against chargeback risk and data security too, which is ever increasing. So we're seeing some new trends appear in on and offline, not just the payment types themselves, but the ways to integrate the customer responses from sales delivery, response to direct marketing, where some traditional types of client management systems and order delivery systems would have been very separate from maybe your online sales, your offline sales. The challenge comes in how to bring that all together in a seamless way so that each area for performing the different functions work together. So some of the newer types of management systems tend to be catering for that, but the organisational culture needs to move on so that different departments talk to each other. A good example of that is a company which has, for example, a very skilled online marketing manager or an online payment expert might not necessarily be in close contact with the department that's dealing with the mail shots, delivery of the catalogue, and the paper responses that come back with that and capture. So they could be missing a few tricks there by not integrating both types of payment and payment receipt to provide a common offering. So omni-channel is what we call that. The word of the day. Yesterday I was speaking about cross-channel marketing, which was concerned with offering different types of payments and appreciating that sometimes customers will use different channels. One, to maybe view and decide what they're going to buy, to work on an offline basis, and maybe go to the website to place the orders that way. And again, that varies from different age groups. It's a very hot topic at the moment. I guess you would have seen a lot of hype surrounding mobile commerce. It's certainly growing. We've got the forecast there. By the end of this year, 12.5% of all e-commerce transactions will be mobile. Now, let's take a step back from that and think about what we're talking about here. Payments themselves haven't changed for decades. Maybe with the exception of one or two things like outbound faster payments, for example. Most of the developments that I've seen seem to be surrounding the way of messaging the banks. The underlying payment at the end of the day is still the same, whether it's a credit card or whatever, but there are different devices that people are using to communicate the message to the bank. 20 years ago, for example, people would commonly send a letter to the bank, signed, please instructing their bank to make a payment. That wasn't called a letter payment. It was just a letter to the bank to make the payment. And I'll argue that mobile payments are basically a messaging service to tell the bank to do something. Rapid adoption of smartphones is driving a lot of this. People have got time on their hands, and in the space of 5 minutes waiting for a cab or a bus, they could have viewed the product, placed the order. So the challenge there is adapting what you're doing on the web, for example, at the moment, to mobile technologies to make it easy for your customers to make the purchases. Online, for example, a range of different payment options, I'll go back to card processing, for example, exist where there could be a hosted payment page or a shopping cart. What you need to do is ensure that that is adapted to smartphone type service delivery where it all fits on the screen nicely. And you haven't got a tiny weeny area to key the card number for example, because that's going to turn people off. Basic stuff. So adapting to mobile devices without ruining the customer experience is very important. Security is obviously a big issue. I don't know how many of you in the room understand the way that smartphones work and what's really going on inside the smartphone. Going back to the old traditional mobile phones, the Nokias and all that, and the telephone hacking scandal, I mean, that was all a big surprise for a lot of people. Who knows what's going on inside the phone, what hacking's going on inside the phone. And the big issue is for banking and payment technology is to bolt it down and keep it secure when people are typing in card numbers to place orders online. PCI DSS, it stands for Payment Card Industry Data Security, and that's a particular type of security and compliance regime aimed at protecting cardholder data, and Visa and MasterCard have actually developed those rules. And if you're going to process credit cards, you're going to need to become PCI compliant or choose a payment partner who is, so you're not at risk of losing cardholder information or card numbers to unauthorized people. A few high-profile cases on the internet where some big shopping carts and stores were basically closed until they fixed the problem when they lost some cardholder data. So that becomes very important. And not only the risk to the merchants, but trust in the smartphone. If that goes out the window for making payments, it's going to be very hard to get consumer confidence back to placing orders on smartphones. So a lot to think about. Here's a new term, financial inclusion. Not just talking about the UK, we're talking about other markets other countries where there could be a high proportion of unbanked customers. And there could be various reasons for that. People might not have access to actual banks because of the distribution of population in a particular country, maybe away from large cities, could influence it. Certainly the case in some African countries. Also, there might have been different regimes over the years and wars, war-torn countries. Eastern Europe suffered from that for a while. Or maybe attitude of the people due to corruption in the country and within the banks. Indeed, that's been true in certain countries. Just to buck that trend, some of the Eastern European countries, I was surprised to see how well their banking systems have developed, because they'd actually gone from back to the drawing board to create new banking systems rather than bolting onto legacy systems and banking cultures that have developed over 100 years. And we all know what's happened in the UK. That's not necessarily a good thing. So being able to create a new bank and a new system, taking the best from what's happened in other countries, can be very good for the consumer and good for the banking industry and help the development of new payment systems. Sometimes surprised to hear countries where they trial a new payment system in a third world country. I think, well, why is that? How can they just do it as quickly as that? It's because they haven't got years of banking regulation to go through. They can get it to market quite quickly and test and prove it in those particular markets. So messaging services, messaging trends, they're developing all the time. The actual banking and the payments behind those take a long time to develop because of, I guess, I don't want to knock the banks too much here, but banks, the organisational culture within the banks are way different from the Apple Corporation, for example. Lots of committee meetings, and right now most of the big banks are concerned with other things. Whilst we see a few new innovations, I think things will take longer to change within the banks to support brand new payment systems. So a few examples here. Payments to a mobile phone account or take payments from a mobile phone account. That's become popular where someone wants to make an impulse purchase using their mobile phone and the unit price is deducted from their mobile phone bill. What's really happened is they haven't actually paid for that until their mobile phone statement is debited by direct debit from their real bank account. But the company delivering the service has actually received value straight away. So it works really great for immediate purchases on the phone. Costs of such transactions tend to be very high. Up to 40% of the turnover can go to the mobile phone providers and a few other companies within the supply chain. So if you haven't got if you've got a big margin to play with, then that's not so bad. But if you're squeezed and you're delivering a particular product rather than a service, that might not necessarily work for you. Wallets such as Google Wallet, they're pushing beyond e-commerce into the high streets. And if you take, for example, PayPal, who are trying to push the boundaries within the constraints of the banking system, their recent launch of chip and pin device in the UK market is very interesting. And that's in what I would call cardholder present environment for stores, for example, where the little device works in conjunction with a smartphone so that the card is really dipped in there and the chip and pin number can be used in the same way it would be for a more expensive device. And these are going to be coming out about £100 and aimed at the very small retailer that hasn't got the investment to deploy lots of smart card readers and chip and pin devices. And also in cases where there's one event or something that's going to happen in a short period of time and they don't want a long contract. So that's an interesting development. PayPal going from predominantly online to offline cardholder present situation. So that's something to keep an eye on. So let's discuss some particular payment types now, and mentioned earlier how consumers have different payment preferences, and that's driven by a few things. Attitude to debt, for example. Do people want to use a credit card and pay later or prefer a debit card? Tradition, habit, for example, and the comfort zone of the particular market in question. Payment by invoice is relatively new to the UK, and the big question mark is whether that actually fits, whether people actually do that here. But in some countries, people are very comfortable. In fact, companies are very comfortable to ship the product with invoice and wait for payment afterwards. And that seems quite bizarre to do that. Who in their right mind would want to do that? It's very popular in Germany, for example, and some Scandinavian countries. And the facility to return the product is there to make things easy. But rather than buy now with a credit card and pay later, that's not such a good fit, because attitude towards debt in those countries is way different from the UK and way different from US, for example, who love their credit card. So what kind of things can help in terms of payment by invoice? Payment by invoice basically means that you have to facilitate receiving a payment directly to your bank account. Some key benefits in comparison with, say, a credit card transaction are that the payment cannot be charged back. It's just like giving someone cash. And that's great if you're a merchant receiving the payment, or if you've got a higher value item, maybe it's a piece of furniture you're selling, for example, a couple of £1,000, where you'd stand to lose quite a big sum if someone charged it back if they had a dispute over the transaction. So quite handy. SEPA, the Single European Payment Area, it gives a level playing field for transmitting payments cross-border in the Eurozone. So the SEPA rules are basically that people shouldn't be paying any more for a cross-border payment in the Eurozone than they would do within their own home country. And the UK is in the European payment area as well. So it's possible to send a SEPA payment to and from the UK. Even though it's a different currency, it will be converted, but it's still a very cost-effective way to transfer funds. And in fact, you can encourage customers to pay within the Eurozone direct to a bank account here. It's no problem. I know if you've used eBay, for example, they say, if anyone sends you a separate email saying pay direct to account, be warned. But actually, in Germany and other markets, it's very common for people to ask to pay direct to bank account, and can be good in some cases. Yeah. Here's another one. Paper mandate and paperless direct debiting. Direct debiting has evolved a lot. The principles are still the same, but it was predominantly for utility companies where there's a deeper relationship with the customer because they know where their customers live. So if anything went wrong, they know exactly where they are. So that was a different type of environment. People are happy to sign on a bit of paper, and there's a lot of comfort there in that you know who the person is taking the money from your account. Direct debiting then became more of a mass market thing for other industries, still paper-based, where there's a signature on a bit of paper, an instruction or mandate, as we call it, and that was quite popular. It then evolved to save a lot of administration. The bits of paper, the signed instruction, basically when they're sent back to the originator, the merchant collecting the funds, they wouldn't need to be sent to the payer's bank. So there's an electronic message to actually cut that whole thing out of the loop to speed things up. And going beyond that, quite racy at the time, was the evolution of direct debiting to allow what we call paperless direct debiting. Well, basically what that means is no signature on any piece of paper to collect a direct debit. And I'm talking about the UK market in particular here. Direct debits are very popular now, can be used online and work very good in some situations. Something to bear in mind, though, with a direct debit compared to a credit card is that the revocation period, for example, if there's a dispute over who authorised the payment or I didn't get my product or service, with a direct debit, it's a much longer period. For credit cards, are typically 60 days for a chargeback. Direct debit, much, much longer. And as a merchant, you need to publish a guarantee. So for the consumer, it's very much in their face as to what their rights are. If they don't get the service they want or something's been debited in error, they can go to their bank. Basically, you have to publish the direct debit guarantee to them, and they can claim the money back. And that's a big risk for merchants. Direct debiting has evolved even further. I mentioned SEPA, the Single European Payment Area, to enable direct debits to be collected right across the Eurozone using a common payment type, a common delivery channel and integration. Whereas historically each country has got its own little system that's been developed and is unique and particular to each country. So this is a great opportunity if someone's collecting by direct debit in the UK, wants to go to other countries. You won't need to go to every bank in every country to do a separate integration, which is very costly. You can go to one provider and cover multiple markets for it. Saying that, though, some individual direct debiting schemes in each country can be better than what's emerged on the SEPA DD. For example, in the Netherlands and Germany, it's possible to go and collect just one payment from a person's bank account, a one-hit direct debit. And what facilitates that is the fact that it's not a lengthy sign-up process with a paper instruction. Lots of consumer rights if there is a dispute, but it just enables it, makes it much easier to go and collect one transaction. And that can be used for online and offline sales. For example, direct marketers, we've got direct marketers that use that as a method of collection. Also works well if someone's taking an order, if a call centre is taking an order by phone and literally they're just taking the bank account details, they can just take a one hit for that particular sale. So that can work really well. So, you've understood what your customers' needs are, and you listen to how they want to do and their payment preferences. You've developed a strategy to offer more than one payment type, which is obviously quite good, and cater for different countries. But how do you work that within your organisation? How do you gear yourself up for managing different bank accounts of different suppliers and different banks? As companies have evolved, they've ended up with different hubs and different operational centres in different countries, which can work well, but there are a lot of economies of scale lost by having a decentralised model with operations and maybe outsourcing to various fulfilment centres in different countries to handle the mailing and the receiving of paper cheques and credit card orders and that. What that means is you've got a bigger volume of payments. You can negotiate a better deal with the banks, with your supplier. You reduce the administration as well that would go with trying to monitor what's going on in these local setups. And you miss a big trick in terms of treasury management if you've got local bank accounts when you can collate and collect everything and receive funds into a central point. So centralisation is an interesting area. Treasury management becomes much easier. And you can actually go for one particular system which covers all of that. But sometimes it's easier said than done. If you've acquired a new company or a company in a new country, you need to drop their back office system or accounting system. That can take a bit of time. So choosing payment partners is another interesting area. Whether it be a bank or a payment service provider, you can do it yourself if you've got the resource to liaise with the banks, research what the best payment types in a country are, and deal with individual integrations. Amazon would be a good example of that, where they would have the resource to do the local thing. Or you can choose a payment partner who will help you go into new markets, maybe have one or two integrations, negotiate pricing once, and open the door so you can expand into new markets easily without sending people on the ground going to deal with the banks. Opening accounts basically is a lot different to what it was 10 years ago now. Lots of KYC, lots of regulation of the banks to prevent money laundering. And bank account opening, for example, can take up to 6 months, even for a respectable company, much, much longer than it used to be. So there are ways you can hit the ground running without having to necessarily do that. And that's where payment service companies, or PSPs as they're known, come into it. So you can leave the heavy lifting to the payment experts. And that kind of sums it up, really. But we're obviously watching the case, seeing who's going to be the new kid on the block, whether there is anything really seriously being developed by the banks to revolutionise the way we work with customers.